Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
When we began the year 2020, we did so with an economic environment that was one of the best ever. 3.5% unemployment, 3.5% mortgage rates. The year started out with a lot of promise for not only housing, but for the U.S. economy in general. And then COVID-19 showed up. And of course, we all know a lot more about COVID-19 right now than we hoped to when the year started. We also have, as a nation, faced an awful lot of unrest this year. The racial divide showed itself again this year, and each one of us has had to go through the process of dealing with that. I want to remind you of two things today. First, we're all in it together. We're all Americans, and I would just encourage all of you to wear a mask. Do it for others. You know, the scripture calls us to love our neighbors, and by wearing a mask, it really showcases the idea that you care about somebody else. And even if you don't believe it's beneficial, another person that you cross paths with might think it is, and they might feel a certain sense of fear. And what we can do together is we can reduce that. Wear the mask. Second, on the issue of unrest, I'm going to share with you a simple philosophy that I hope and pray all of you will adopt with me. And that is this, that I'm for everyone. I'm not for everything, but I'm still for everyone. I hope all of us, if we want to stay united as a nation, if we want to stay united as a family, as a business, we need to be for everyone, even though we're not going to agree on everything. Be for everyone. All right, wear your mask. Be for everyone, not everything. Let's get started with News You Can Use. Why did we create News You Can Use? We did so because when COVID-19 took place, we put our economy into a coma. That's right. We decided to shut it down. And therefore, the environment that started the year was going to be no longer. In fact, we lost at one point over a 10-week period of time, 40 million jobs because we shut down the restaurant business, the travel business, the entertainment business, the sports business, concert business. We shut down many of those businesses that employed almost 40 million people. Why? Because it created assembly of people, and we were trying to flatten the curve to keep from overrunning our hospitals. We'll get back to that a little bit later in the program. But why we created News You Could Use was to offer all of you what we hope to do, which is to offer you inspiration and education. News You Can Use is education benefiting you and your customers. That's why we created it. So we wanted to take the data and the environment that we were in, and we wanted to share with you as best we possibly could so that you could create benefit for yourself with your sellers and with your buyers. Today, we are all blessed because we're joined by one of the top economic forecasters in the world, and specifically and arguably the best housing economic forecaster in the world. He's the chief economist with Fannie Mae, the largest housing finance company in the world. Please join me in welcoming to News You Can Use, Doug Duncan. Doug, welcome back. Jamie Dimon, CEO of JP Morgan, one of the largest investment banks in the world, said this past weekend that we're experiencing an unprecedented environment when it comes to economic forecasting. It's more challenging than ever. Well, today's guest is responsible for economic forecasting at Fannie Mae, the biggest housing financier in the world. Doug Duncan, welcome to News You Can Use.
Thanks for inviting me.
Yeah, we're glad you took the time today. Doug, do you agree with Jamie that today's environment is the most, let's say, unprecedented, complex for an economic forecast?
It is. I do agree with that. And it is primarily because the driving factor is fear of a disease and presence of that disease. It's not an economic phenomenon. It's more of a it's a health and a psychological phenomenon which is affecting behavior.
So normally as a forecaster, and obviously you've been at this for a while as your team, as you're responsible for your team, what are the key inputs that you all consider normally when you're thinking about the overall economy and housing? What are those key inputs from a forecaster standpoint?
Well, we're looking at things that affect economic growth. So those things are consumption, investment, government spending, all of which are related to employment and income. So what's happened this time that makes it so difficult is the fear of the disease has led middle and upper income households to retract spending on what is discretionary consumption. So that discretionary consumption is theaters, sporting events, airplanes, hotels, those kinds of leisure activities, which you don't have to do those things, but if you have that discretionary income, you do it. What that led to is a tremendous increase in unemployment among service sector workers that provide the output that's consumed in those spaces. Those tend to be hourly wage workers, not salaried workers. So you can kind of see where the impact of that is.
So if what's normal is tracking all of the inputs that affect employment as the key kind of propeller for the economy, whether it's overall or in housing, what are you adding in now from an input standpoint that COVID has showed up when you're thinking about your forecast?
We've actually changed the terminology to some degree to reflect how we are thinking about the various models that we run. So what we address now is our baseline scenario. It suggests that there's less certainty about the interrelationships that we've seen in the past in economic activity, and therefore, and it's because that less certainty exists because it's driven by something that's outside normal economic models, and again, that's the disease. So we daily look at the things that you and I have talked about, which is the infection rate, the hospitalization rate, those kinds of things, to try to understand how that will affect people's psychology. Will the change in the incidence, duration, and severity of the disease impact their behaviors? And if so, then we have to adjust our scenario. That's why you're hearing people talking about, is it going to be a V-shaped recovery or a W-shaped recovery or an L-shaped recovery or a Nike swoosh, or all the economists are saying a radical, which is a square root symbol.
That's the latest in the order of what's possible for the recovery. So let's shift to what your forecast is actually telling you now. I know you recently updated your forecast for 2020 and 2021. Talk us through, based on the unprecedented environment and all of the inputs, talk us through where you all see both the economy and then more specifically where you see housing going next.
On economic activity, our thought is that the economy will shrink. That is, it will be smaller at the end of 2020 than it was in 2019 by between 4 and 5%. So that's a big move. Typically, economic activity moves 2 to 3% and in an upward direction. And in a normal recession, it wouldn't fall nearly that much. So it doesn't sound huge numerically, but it's actually a big drop in economic output. What that suggests is that at the end of the year, that is 2020, unemployment will be somewhere in the 8 to 9% range, and then even next year, this will be a slow recovery. Even at the end of 2021, we would expect unemployment still to be in the 7% range. Both of those numbers depend a lot on the response to the rise in the virus in the South geographically. Housing has done better. That is, purchase and refinancing of housing has done better by quite a bit than people expected. You and I have talked over the last couple of years about if there's a downturn, housing is likely to be the cushion to that downturn because of the slower growth of supply relative to demand. That's turning out to be true. So once in a while, when you get it right, you like to don't look surprised. So that's turned out to be true. House prices have actually risen because concerns among people who could list their homes for available sale have been greater than those who've seen the low interest rates and have an interest in buying. So that imbalance between the drop in supply and the drop in demand has meant house prices actually have risen. So we expect overall this year about an 11% decline in, I think this is, about 11% decline in existing home sales and about a 2.5% decline in new home sales across the course of the full year. So still a pretty good environment given what's happened. If you're in the rental side of the business, that's where the stress is going to be, is that the hourly wage workers are primarily renters.
So it's been resilient housing, and we went into the year, and one of the obstructions, because we had the lowest unemployment rate ever when we started the year, and we had the lowest interest rates ever that we both talked about, and then we were talking about the housing market maybe doing a 2% or 3% increase. You actually had a 2.7 number going into 2020, and then of course we had COVID, and unemployment has gone to 11. I think a lot of us in housing have been surprised by the resilience. Is that because there was just not enough inventory of houses to sell, but there was a lot of buyers that were out there? And to your point, the employment that we've lost has been in the lower income sector. Is that how we should think about it?
That's right. Typically, house prices in what I would call a market where it's evenly balanced between the demand side and the supply side. So there's available supply for people that are qualified to make purchases. Typically, house prices in that environment, if you adjust them for inflation, would rise about 0.75% annually. Then you add in the rate of inflation, you get to what the nominal price increase is. We've been seeing for over 5 years, we've seen house prices appreciate inflation adjusted at a much stronger pace than that, simply because the millennials were moving in as the buyers and supply was not growing as rapidly. So that was entering this period. Interest rates now have dropped, obviously dramatically, first of all because of the drop in economic activity, then because the Fed moved their target for interest rates down. But we actually are expecting rates to fall further. So the question is, why do we expect that? Well, if you look in April, the spread between the 10-year Treasury rate and the 30-year fixed rate mortgage was at about 265 basis points. The average spread in 2019 was 180. It's come down to about 235 right now, but that still suggests there's more room to go in terms of that spread narrowing. So we've had to bump up our expectation for refinancing to 1.9 trillion this year, and still another 1.1 trillion next year. Purchases about 1.25 trillion this year, and over 1.3 next year because of that drop in rates. We think you'll see rates down around 2 3/4 when we get to bottom.
Hey, one of the common questions that folks that invest would ask someone like myself is, what keeps you up at night? And so as a forecaster, I'm going to ask you a question that I commonly get asked about running my business, which is what keeps me up at night. Doug, in terms of forecasting, what's keeping you up at night right now?
I anticipated that our board of directors would ask me that last week when we had the board meeting. And so I showed them a chart. I'm an economist, so I have to show a chart. And what that chart shows is from the peak of employment before each recession, how long does it take after the recession to recover that level of employment? The last 4 recessions that we've had, each recession, it has gotten longer and longer. So even though this was the longest economic expansion we've ever had, it also took the longest of any post-World War II expansion to recover that pre-recession level of employment. I really worry about how we're going to get back all those service sector jobs and whether or not there's going to be some underlying social turmoil that will be augmented by the very slow return of that service sector employment. And I don't know why it is that has systematically been expanding, but I think that there's some warning signals in that data.
So one of the questions right now, the Fed obviously has been aggressive since the very beginning. They've thrown almost everything at it that is in support of monetary policy. And Washington, to this point, has done fairly well. As you're looking now kind of at the next chapter over the next 30 days, how important is it that we get another stimulus out to all of those that have been affected at this point?
Well, there's no question that that is a lifeline for a lot of folks. And of course, you've seen, if you track the restaurant data, for example, which is where there's a lot of hourly wage workers or theaters or airlines, you can see the business has not picked back up. So they're not going to be hiring those people back anytime soon. So that $600 a week that folks are getting, I think there's going to be something done in that area. The debate is around the fact that in some states, the level of unemployment insurance benefits, adding in that $600 a week actually means workers are paid more than they were on unemployment. They're paid more than they were when they were working. And so it's an incentive for them not to go back to work. I think that's one of the rubs between the White House and the Congress that they're trying to sort out, but I think we will see something.
Yeah, if nothing else, it's felt like whether it was all perfectly targeted, of course, whenever you do things in the middle of the night, which is what they've been doing, simply because of the nature of how this COVID came about, it just happened and caught everyone off guard to a great extent. It felt like that the stimulus after the Fed, the stimulus has at least created a kind of foundation for some confidence to maintain. And that has been the thing that I've been thinking about recently. If we don't offer another round of that, where do we go? Does the shoe drop, and do we see, kind of more fear ending up in the marketplace? I know you've got to go. I wanted to ask you if you have any final thoughts, first of all, that you would offer to us with regard to housing specifically in the second half of this year.
Well, the interest rates are not going to go anywhere except down. So that's going to be a support. The biggest concern is whether or not the reduction in employment in the service sector and hourly wage workers moves over into the salaried space, because some of those businesses don't see recovery, so they start laying off management, which is often salaried. And then at the state level, most states have a balanced budget requirement. And if they need to lay people off, a lot of those people are salaried workers and homeowners as well. So I think that's where the risks are. The good news is that it seems early in this geographic shift of the virus that the hospitalization rates, while they're rising, haven't been as strong as they have been in other sectors of the country, and potentially suggests that we'll make progress through this without another complete shutdown. All of that is helpful for housing. So we'll just have to watch the virus.
Hey, last question, Doug, and I always ask you this, is if you were talking to your son or your daughter in the middle of this event right now, right where we are in the middle of July 2020, knowing everything we know, is it a good time to sell your home, a good time to buy a home?
Well, it goes back to your family budget. If you've got a family budget, and I hope you do, at today's interest rates and with what you know about the stability of your employment, if it fits the budget, you have reasons to be confident about the stability of your employment. It's a pretty good time to buy a house, but just make sure that it's a prudent, well-reasoned decision.
Well, listen, I regularly pray for you and your family. I'm grateful to know that those prayers have been answered to an extent, particularly with Mrs. Duncan, the boss in your household. I'm going to pray for you additionally about that, but I'm also going to pray for you with regard to your forecasting going forward with the challenges that it says. Thank you so much, by the way, Doug, for being a part of our program this morning.
Thank you, and thank you for all the prayers. They have been effective. We cherish that. Thank you.
All right. God bless.
You as well.
It was a blessing to have Doug here with us again today, and I'm sure all of you, like me, feel blessed that at least our area of the economy is continuing to show itself as a V in recovery, right? So a lot of our neighbors are not as blessed. I would ask you all to be more generous than you've ever been right now in support of your neighbors and friends that are less blessed. The question about whether the recovery is going to be a V victory or a U, we would take that as well, right? We go down and come back up, or a W, not really what we're hoping for, but it is getting talked about more and more today because of the potential issues with COVID. That is the number of new cases. We'll get back to that in a second. Or a Nike swoosh, the greatest marketing company, one of them ever, right? Or an L, where we go down and we don't recover. We've just now had another concept introduced. That's how complex this thing, COVID-19, has become. And now it is a radical or a square root. We won't spend any more time on that one today. We'll bring it back to you next week if it's necessary to bring back, but that's the latest kind of recovery that's being at least contemplated by economists. We're not COVID experts here at Supreme. We'll leave that up to the CDC and to Johns Hopkins, two of the top organizations in terms of their viewpoints on all of these issues, and they are creating a data set. While we're not COVID experts, we're also not the media. And oftentimes the media will present information to create an event so that they can get eyeballs on them. So, and you all are overindulged with COVID-19, but I thought that we would spend a few minutes talking specifically about COVID-19 because we feel like we have assessed and really worked to identify a set of inputs that tell us maybe a story that's a little bit different than the one that the media is telling. So let's go to work on that. First of all, there is no debate, none at all, that cases are now setting records. We have seen them go from a high of 40,000 in a day back in the early parts around April, and then all of the work that was done in terms of wearing masks, wear your mask, all the work that was done, social distance, all of those things happened, and we saw case numbers declining. And then recently, of course, the news, the media has told us the truth, which is cases are climbing and rapidly. So on the one hand, when you hear that, we immediately think of the worst things about COVID, right? It's not cases that have bothered us from the beginning. It's hospitalizations, and none of us want to go to the hospital. And then finally, it's deaths. If it wasn't about hospitalizations and deaths, it's just another new, really aggressive, especially with certain people, flu. But let's take you into the detail a little bit more because I think you'll find these numbers interesting. First of all the way to the left on this chart, this is the number of new tests. So when you also hear the president talk about we're doing more tests, we're up to about 800,000, just under 800,000 now in a single day. A single day, 800,000. Early in this process, we only tested those really who went to the hospital who were really sick because we didn't have enough tests. So we are testing a lot more. The truth is, we also are, once we test, finding out we have more COVID-19 confirms. In fact, the case numbers now are up to 60 to 70,000 per day, but it is across the country now. It's spreading out across the country, which in some ways is good because then those that need hospitalizations and treatment aren't dependent upon like we were early on, where it was really a New York-centric event. It has now turned into a national event. So in some ways, that's not good, but viruses do spread. But at least now we're not depending upon one health system, New York, to support what's happening with the spread of COVID. Let's go back to hospitalizations just for a second. I want to show you that they are on the incline. We had gone down to about 35,000. We're now up to about 60,000 again. So that's not great news. But I'll tell you what is really interesting is deaths have not yet moved. In fact, we've seen deaths decline, and now they have flattened, and we have not seen them increase yet. Let's keep our fingers crossed. Let's be for not a party, Republicans or Democrats, or who's right. Let's be for deaths not going up. How about that? Can we all say amen to that? Amen. Okay. I want to show you a very interesting chart. This is probably the most compelling chart because it tells us that while new cases are really high, it's more important who, not that the cases are going up. It's more important who is actually getting sick. And why is that? Well, if you look at this chart here of cases so far, hospitalizations, which is in the orange, and deaths, which is in the red, what you see is 0 to 4-year-olds don't go to the hospital and they don't die. 5 to 9, don't go to the hospital, don't die. 10 to 17, don't go to the hospital, don't die. 18 to 29, some go to the hospital. Very few die. 30 to 39, some go to the hospital. Very few die. That story continues really until you get to 60 to 70-year-olds and you start seeing deaths go up. And then when you get to 70 plus or 80 plus, you really see the incline of deaths take place. So what really this data is telling us is not that there are no young people who don't get hospitalized, and it's not that there's no young people that haven't died. It's just very few people that are younger, below the age of 60, that are otherwise healthy, go to the hospital, and fewer even die. So if the new cases are increasing, and they are, and they're increasing for younger people, and they are, an awful lot of younger people have been confirmed recently, then we should conclude that it's most likely that deaths are not going to incline the way cases are and the way hospitalizations have. And that's what we should all be for. Beyond being for everyone, we should be for that outcome, which is that we don't see deaths go up. I want to show you another really interesting chart. This is a deaths in America list, kind of what's gone on since January of 2017. So this is deaths over the last 3 years. You can see the orange line is kind of the averages. So this is every year of all the people who die. Forget why they die. These are deaths of all the people that are actually dying in America. We are now currently having fewer people die in our country at this stage than we've had at any time in the last 3 years. And we have more people today than we did 3 years ago. So effectively, the death numbers in America in total are coming down. And so here's what we need to keep a close eye on. Two things. One, the number of new cases, who and what age group are they in? And knowing that we now treat COVID better, we should see deaths not mirror what we saw early on, and therefore death rates for COVID confirmed 19s should be coming down over the next month. Total deaths hopefully stay flat with the number of new cases confirmed higher. Death rates for this particular virus will come down. That's what we expect to happen. We'll keep you updated in our next and following News You Can Use programs. Let's tune now to Supreme Southeast. Let's talk about your home buyers. Let's talk about credit scores, which have been a concern because of the nature of financing and the importance of credit scores. A, to be able to get a customer to be able to be eligible to buy a home, which is good for you and good for us. And then second, what do they actually pay for the interest rate? We are at record low rates, but of course, the lower the credit score, the higher the rate. They work inversely. So home buyers are held back potentially by credit scores. What did we do? Well, we responded at Supreme Southeast by creating what is now known as Credit Essentials. It airs on Wednesday and it airs on Saturday. We changed it from Fridays at 1 o'clock. We've added Saturdays, and we're going to Wednesday after hours now so that more of your potential home buyers can attend. Credit Essentials is hosted by Lisa Myers, who now is reverently referred to internally here as the Credit Whisperer. And this is the reason why. So far, she's served 439 of your customers. And their average credit score would not qualify, the average would not qualify to be able to get a home loan, 615. You need 620. Well, guess what? The finishing credit score after they've gone to Lisa's program and worked through her counseling is 667, which is certainly qualified to buy a home. And the interest rate at 620, if they stayed at 620 versus 667, is about a half a point in rate lower. So instead of them getting, say, 3 or 3 1/4, they would get 3 3/4 unless Lisa got involved. So when you refer your customers to Supreme, tell them we've got Credit Essentials. Go to a half-hour program on Saturday or Wednesday evening. It'll not only improve your score for the purposes of home buying, it'll improve your score so your credit card costs can come down, automobile costs, anything that requires a credit score, they charge you based on that score. We get you a better score, you get a better deal. All right, let's talk about service. Doug mentioned an avalanche of refinances. In fact, he just increased his yearly expectation this year by $300 billion of mortgage financing because refinances are going higher because we have now hit all-time record lows with 30-year fixed-rate mortgages. So folks are focusing on refinances in our industry. Supreme is focused on your business, getting your business, moving people with contracts from A to Z so that you can get your money, ultimately get paid on time, right? That's a big deal. So our customer sat rates, our service standards suggest that our rate of satisfaction is actually going higher during this record-setting period of time at Supreme. So our surveys are done at closing. That way we get 95% of them back, statistically way past valid. And our customers are telling us, 98.77% of them are telling us they're extremely satisfied with the Supreme service experience. By the way, close on time, fund on time, kind of important so people can move on time, of course. Kind of important so you can get paid on time, of course. Our closing and funding on time rate is 99.5%, 99.5%. By the way, we're the only company in our industry that even tracks this number. So if you want to close on time and fund on time so you can get your customers highly satisfied, raving fans, and you can get paid on time, I would strongly recommend you call one of your Supreme loan officers because 99.5% of the time, we're going to deliver on time. Let's talk about speed. The industry today, overwhelmed by refinances, okay, is now at 50 days on average to produce a mortgage. We are at 21.9. We're less than half of the time that the industry's taking to move a mortgage from A to Z. By the way, next time you're representing a buyer and there's going to be multiple bids, which is often, you can put as a feature in the contract that not only can you get done in 21.9 days, with Supreme, you can get done faster than that. In fact, we go really fast when you want us to. In as low as 8 days, as little as 8 days, we could take a mortgage application and close it. We would be able to do it quicker than that if not for the fact that the federal government requires us to give disclosure, and so it's an 8-day process at minimum. But we can go from application to closing in as little as 8 days. Again, just talk with one of your Supreme loan officers to get access to Credit Essentials, to get access to top box customer sat so that you can get raving fans on your side, so that you can get access to getting paid on time. Makes sense to me. I hope it makes sense to you. We started with, I am for everyone. I'm not for everything, but I am for everyone. I hope that all of you will join us in adopting this concept because we don't want our nation to be divided. It tells us in Scripture that a nation divided against itself cannot stand. And we can all be part, every single one of us can be a part of the solution by not calling people names, by not, because someone's different, either the way they look or what they believe. We don't have to be against them. we can still be for them, just not for everything. And I just strongly suggest that all of us adopt this idea. And if we do, we'll all get to make the world a better place. I told you we're all about inspiration and education. Today, News You Can Use, all about education. Hopefully you've taken a lot of good nuggets with you that'll be beneficial as a professional for you and for your sellers and for your buyers and for your family, for that matter, with COVID-19 information. I want to close by telling you inspiration is coming next. August 6th, we are going to be interviewing one of the all-time great, and I mean all-time great, not only college players, pro football players, but not only that, he was a U.S. Olympian. He's been an MMA fighter. He now owns and is CEO of one of the top minority food services business in America, none other than Georgia's own Herschel Walker. And I'll tell you what, you're in for a treat. If you want to become your personal and professional best, and we all do, come to our show on August 6th. I promise you, he has an awful lot of wisdom to share with you about how you can indeed become your personal and professional best. God bless all of you. We'll see you again next week on News You Can Use at 3 o'clock.